we really wanted to bring them here because they have tons of experience. They've been working with a lot of brands on helping them raise the capital. So I will let you both, Tom and Michael, give a little bit of introduction and we can start.
Thank you. And thank you, Luke, as well. It's great to be here. I'm Michael Movitz, one of the co-founders of Brandjectory, and with me is, as was said, Tom Malengo, my co-founder and partner. And I thought I saw Susan. Yes, Susan Bryanton as well. Just for context, I've been in the natural products industry for 33 years, retailer, broker, manufacturer, spins for 16 years, last 7 years working with early stage founders and go-to-market strategy and preparing to raise capital. And Tom and Susan and myself and one other partner built and released Brandjectory a few years ago because we saw the great need in the CPG sector, specifically for how hard it was for early stage founders, particularly under $1 million in revenue, to access resources specifically about CPG capital and CPG investors. So our objective is to try to democratize the access to both CPG investors and resources. We help founders to prepare for the capital raise process and navigate that capital raise process. We do it through a combination of both an online platform and offline virtual facilitated meetings. We don't get involved in the transactions, so we don't take a success fee or a commission. We're a straight, simple subscription model. There's 130 founders on our platform now and over 650 investors in our network. And we have both the content, structure, process, best practices that we help to support our founders with through a very robust knowledge base about building an investable CPG business, a mentoring platform where our founders can meet one-on-one with investors and other industry experts, a variety of different virtual meetings, founder investor meetups, Q&A sessions with financial professionals, and access to both investor capital as well as debt resources, which, as we continue to grow, adding more access to more capital sources is key. And I know Tom will be speaking about that more in a second. So again, thank you for having us. I'm going to share my screen, and the session is being recorded. And we will also share these slides after the session. So with that, I've gone through our introductions, and I'm going to hand it over to Tom to kick us off.
Hi, everyone. Tom Malengo here. Excited to be here today. This is a topic that we very much have a great deal of feel and desire, and just a natural part of us wants to see brands succeed and wants to give them the resources that they need. So the big question is, when should you start raising money? And the answer to that is always today. You should always be ready to start raising money. You should always be in that position. At the same time, and I think it's important for us to help set the context for where we're at today, is that, today's a different animal than it was years ago. If we were talking a few years ago, you would hear investors say, oh, it takes a lot of money to build a CPG brand. And that's not the way it is today. Investor money is tight, and there's reasons for that. The general economy. And the general economy has put a crimp in the total assets of private investors and the people that invest in investment funds. They've seen their net worth down 10 to 30% over the last couple of years. And yet investment funds and growth investors and single family offices, multifamily family offices, they have to produce a return. So where they may have years ago said, hey, I got a few sure bets, things I'm going to really feel good about. Today they say, well, I can't add in these ones I'm less sure about, the ones that may be a longer shot, that they may take a risk on. They're really cramping down on risk. And what they're really doing is looking at when brands are going to be profitable. Hold on to that thought for a second, because what else is happening is the consumer world is changing. it just this week, there's stories out there. The USDA reported that a family of four is spending 45% more on a weekly basis for groceries than they were 2 years ago. Numerator reported that 41% of consumers are trading down in product quality in order to make their budgets. We know private labels are increasing at all, over the last couple of years in terms of use. And we know people are not as loyal as they used to. They're changing brands and they're changing where they buy. So, people that might have bought in the natural channel are going conventional. People that bought conventional may be going to the lower price markets. What that means from an investor perspective is that they want to make sure that you know who you're connecting with as a consumer, where that consumer is, that you know how to reach them, and that you can continue to reach them. They want to know you're going to be profitable in the next 18 to 24 months. And there's reasons for that. They do not want to get diluted out. They want to see a brand have a strong margin, know how to grow their base within where they are, and be able to start funding their own growth. And whether that growth means they got a positive cash flow, they can reinvest, or they have a positive cash flow and they can take non-dilutive debt on, these are things that investors want to see today. So where you may be used to hearing people talk about, oh, we just have to get a big slice of a large market, that's not the way investors are looking at it now. They're looking at it simply as, can this brand, can this business become self-sustainable? Can they fuel themselves within the next 18 to 24 months so that I know I'm going to have an exit down the line where that brand has returned a really positive return on my investment because they've learned how to do it themselves. So they're looking at the strength of that business, and whether it's a creditor or somebody who's going to put equity into you, that's what they're looking for. They want to see that business start to grow and to be able to get that return. So with that, let's start talking about what investors look for. We're going to do this a little bit of conversationally, I think, Michael. I'm going to talk a little bit about, what investor expectations are, and Michael's going to go through a little bit more of what that means, what the detail is, what you need to do. So when an investor looks at your brand, what they want to know is the business solid? They want to know you can meet their expectations, and they really want to have a compatibility with you and your team. They don't want to step in and start doing your work. They want to know you have a strong team, that you're the kind of person that can move from founder to CEO. So that compatibility is a really important part of the whole process. So with that, let's start about business foundation. We kind of already covered this. What the investor wants to know is that business can stand on its own. They want to know that you have all the pieces, parts of a strong business ready for them to really review, get involved in, be an advisor, be a consultant, be the kind of person that can help you drive your metrics. But they want to know that you can follow those metrics, that you have benchmarks. They want to know that your operations are in place. They don't want to risk getting into something with a risky regulatory profile. They want to know you've checked off all the boxes when it comes to things like that. And they want to understand what we already talked about, sort of, where you're headed, but they also want to know that you have a team in place, whether that team is yourself or other people that you contract with or people you've hired to be able to grow that brand. So these are the sort of things that an investor wants to hear from you in those initial meetings. And when they start to get into due diligence, they want to see these things in place. Michael's going to talk a little bit more about what's in these and what you need to be thinking about. Michael?
Thanks, Tom. I'm going to just start on the top left because I think Tom has made it clear as an investor, I'm going to take the position of a founder and the things that I want to bring out in each of these different elements. The intent here is to convey credibility that I have the right foundation in my business, strong foundation before we move on to the next part. So that first piece is that team expertise in the space. A lot of founders don't necessarily have CPG backgrounds, and that's okay. The reality is that we all have strengths and areas that we need improvement on. But the idea is that we're going to surround ourselves with people that have expertise and experience in the space. And so at an early stage, particularly under $1 million, especially under $500,000, there's not enough traction in the market for that investor to be sure about de-risking the investment. And so they're betting on me as the founder. Do I have the right background, the right acumen, the right personality, the right resilience, the right way to, good judgment, right way to manage through different situations? And how do they know that? Well, basically through interactions and conversations that the investor and I have together. So I want to try to convey those different elements, as well as from a career and expertise standpoint. I know how to operate in the CPG space. I understand consumer marketing, channel strategy, sales management, et cetera, within CPG specifically. The second thing within my business plan, I'm not going to write a 50-page business plan. I'm going to spend a couple of pages, maybe 5 to 10, talking about all the different elements that are basically setting the stage for the business as it is today, how I'm produced, why I'm different, my pricing, how I'm going to market, my team, and then my consumer, my product differentiation, and then how we're going to grow over what time horizon and how we win. That is it's really important to have that thought put into it up front. And by the way, you also want to know, what's the exit strategy? Do you want a family business, or do you, a nice $10 to $20 million a year profitable business? Do you want, to balloon up to $80 to $100 million and try to exit to a strategic? Those are important things to be able to document so that you know how to plan and work accordingly. On the operations side, I want to be able to convey confidence to the investor that I have a handle on my operations. That not just about, who is my co-man and are they reliable and do I have a fair agreement with them, but I also want to talk about my supply chain, consistency of availability for my ingredients, and that I have experienced people working on that operations side. Again, in the early stages, I'm probably using agencies and outsourcing, which is fine. But the idea is that I want to de-risk the operational elements from all of the things that I talked about, so that there's no surprises or very little risk in that side of the business. Tom touched on regulatory compliance. Of course, this is more of an issue on supplements than it is necessarily in food and beverage, but everything has regulatory needs. And of course, the more innovative and high-tech ingredients or products tend to be, the more regulatory risk there might be from both from a government oversight standpoint, as well as from a consumer acceptance of something that's very novel. So regulatory compliance is something you definitely want to work with attorneys on to make sure that that is sealed and risk mitigated. Market need. Are you solving a problem that the market actually needs? Me Too products are not exciting for investors. And so the first thing that you have to be able to do is to solve a problem that a consumer has that is in a sizable opportunity, whether it's a category, a segment, or something that you're creating. White space is always going to get a lot more attention and interest from an investor than incremental improvements over existing products. And by the way, the top right one, taste or efficacy and valid science, I can't overstate this importance enough. You don't want to be paralyzed by perfection, but if you do not have a product that tastes good, you will have a one-time sale and nobody will buy it again. Anybody can sell it once, but you'll never have develop a sustainable business that people will come back for. So I want to make sure that my product tastes right, formulated properly, et cetera, and works. I need to have a consumer value proposition. Consumer value proposition basically means that consumers understand what it is that I am offering, and they're validating that through social media feedback. So if I'm out there talking about my proposition is XYZ, and consumers are saying, this is great for ABC, there's a disconnect there. And an investor is going to wonder, am I properly marketing, messaging? Have I missed the mark on how I'm going to market or what I think the product is actually doing? So it's really important to understand, for me to be able to convey my value proposition and how I'm solving the problem for the consumer and how their lives are better from using my product. third to last, to the extent that I have traction in the market and I can talk about revenue or velocity metrics, those are all important. It's okay that you may not have, I may not have, you know, a lot of revenue in the beginning. But what I want to be able to talk about is how my velocity, let's say in retail, or my average order volume and repeat purchase metrics compared to the average for the category and compared to a key competitor or two. So, because if I said, you know, my velocity is 3 or my revenue was X, I don't know in a vacuum if that's good or bad, because I need some reference points. And you can obtain these by standing in the aisle and talking to consumers, or talking to buyers at retailers, talking to whomever will provide you that feedback, to get that understanding of what kind of traction are you getting, and use that to your advantage when I'm talking to investors. I need to have a budget, and I need to make sure that I'm GAAP compliant, generally accepted accounting practices. A lot of times, I'll personally say that, well, Tom and I both have seen plenty of pro formas and P&Ls where trade spend is not in the right place and marketing expenses are not in the right place. And so we need to make sure that expenses are being classified properly and recognized in the right place, because when an investor looks at my numbers, they're going to be first looking for structure to make sure that what's actually happening is what I'm saying is happening. But I also want to have a budget, because I need to know how to, of course, plan. I can't just wing this. I need to know how much money it's going to take to achieve what I want to achieve. And by the way, if I don't know, I need to reach out to people in the industry that have experience, so that I can get that guidance. And lastly, that sort of speaks to the 3-year pro forma. For the first 12 to 18 months, I want to have a monthly projection. And then from that point forward, for the up to 3 years, it's okay to do annually, because a lot of things can change over that time horizon. But certainly over the next 12 months at a minimum, I need to know what's going to be happening from a sales standpoint, expense standpoint, production standpoint. And I want to be able to show my investors in those conversations the importance, or my understanding of what's happening month to month. Tom, is there anything else you would want to add?
Yeah, two points I want to add. One is if you're seeking alternative financing, i.e. some kind of debt financing, operations, the strength of your operations, working with someone like V-Driven to make sure you have no leakages and no unusual deductions, things like that. And understanding your revenue, you know, understanding that production flow, understanding the regularity of it, understanding, you know, what's coming through and your revenue. That's something you really have to understand if you're seeking alternative financing, because that's what they're betting on. They're betting on that you can always have revenue coming in to pay for the cost of operations. The other thing I want to mention, I presented kind of a downside of the economy. There is an upside for brands of the nature we're talking to. First off, premium pricing on premium products hasn't gone up as much as conventional products. So that what a consumer sees is not that different. But taste matters, to Michael's point. Taste and functionality continue to drive, any study you see continues to drive, you know, premium product purchases. So focus on the taste, focus on the efficacy, focus on the valid science, focus on the market need. That's going to be a successful product. Okay, we're going to jump to investor expectations. And this really gets into how you're running your business, okay? This is where an investor wants to see, everything else is sort of stage setting, right? Everything else is, it's there, it's in place, you have it. Now comes into the, can you manage it, okay? And, you know, can you report back to me that you're managing it? Do you have the proper performance indicators? Are they tracking what your goals are? Do you understand the margins, the unit economics? You know, do you understand how that plays into your cash flow, along with all the other expenses that the operating expenses that you have? Do you understand how that's fitting into your burn, your cash flow, when you're going to be profitable? When it comes to things like customer loyalty, this is often overlooked. Customer loyalty is a big one for me. If you know who those customers are and you can continue to build their baskets, you can grow successfully at a small scale. You can grow successfully regionally. Customer loyalty is very important from my perspective. When you get into all the things that come about from an investor value proposition, it really comes down to the investor knowing you can grow the business. How you're going to do it, trust me, the investor knows as well as anybody how big the market for this is going to be, what's a slice you can obtain, things like that. They're not concerned about that as much right now. They want to know you're going to be profitable and that you know how to get there. That's where they're going to start to say, yes, we can make this a great business. So with that, I'm going to turn it over to Michael and let him go through some of the points about these items that are really, really important to how you manage your business on a day-to-day and on a future-looking basis.
Yeah, I think Tom's repetition of the word profitability is just a microcosm of the conversations that have been happening between investors and founders over the last 6 to 12 months in particular. As he said at the beginning, their lens and needs and expectations have shifted. And so when we talk about a solid business foundation, as Tom has said multiple times, that part of that foundation means either being profitable or a path to profitability that you can predict with some reliability. So we'll come back to that, but just running down the list here when we talk about traction KPIs. So, of course, that's revenue, but it's also velocity. Velocity in retail is units per store, per SKU, per week. These are, of course, available through data sources like SPINS, Nielsen, IRI, but you can also get them sometimes from distributors or retailers, or you can back into them. So if you know how many doors you're in and you know how many units shipped, over a given period of time, you can calculate that. Again, as I said before, you also want to be able to talk to reference points so that you know whether what you're doing is good, bad, or ugly. If you're online, repeat purchase, your CAC, your average order value, your lifetime customer value, your return on ad spend, all of these things are important to be able to talk about what's happening. How many 5-star reviews you have is okay, but number of followers is a vanity metric. The key with number of followers is that it's an indication of desire, or interest, but it doesn't. If you don't turn it into and convert it into sales, it's just a nice to know number. Viable unit economics. So we know that we have to make a profit to have a sustainable business. So is your product priced properly to compete in the market or to be properly positioned, whether you're super premium, middle of the road, value pricing, and are you making money? There has to be, when we talk about gross margin, that's gross margin after trade spend. So gross revenue minus allowances, minus trade spend, minus COGS, that's your gross margin. And that gross margin, if you're a food and beverage product, would ideally be at 40% or higher, supplements at 60% or higher. And in the beginning, it's really hard to get there because you're forward investing or you don't have the scale to have beneficial costs associated with your supply chain. That's okay. Investors understand that as long as you can show that over time, how you're managing expenses and how your scale is helping those COGS reductions to occur. And in theory, you should be reducing your trade spend over time as well. But you've got to have a viable unit economic to have a sustainable business. Tom touched on consumer loyalty. I'll just say that, there's a variety of ways to measure that, but repeating purchases is key. Comments on social media, things that people write in to praise your brand about, those are all part of that loyalty. And I, as a founder, want to share that to my potential investors. Repeatable success. This means that in fact, let me back up. It's a 9.5 times out of 10, it's a bad idea to try to go national right out of the gate. It takes an immense amount of money to do that. And especially in the beginning, all we have is hypotheses right now at this early stage, and we need to test them. And if we test and have to make changes, the bigger and broader our distribution and product line is, the more expensive it is to make those adjustments. So and when I'm talking to an investor, I'm telling them that in this retailer, this is how we did and what we did, and these were the outcomes and the results. And an investor will see that, okay, if you did that in one retailer or one market or one region, look at all the other white space opportunity to gain distribution in and to repeat that success. And they start to think, okay, I can start to now multiply that success rate and see how this can really become a big opportunity. The investor value proposition is different from a consumer value proposition. Consumer value proposition is talking about how the product is providing them with convenience, solving a problem, saving them from, giving them an alternative from what they currently have, how it's helping them in their lives, et cetera. An investor value proposition is more focused on the reliability of the business. How is the investor going to make money? How strong is your supply chain? Is your operational systems? And all the kinds of things that have to do with your business model and how the business will scale from a sustainable standpoint. And some benchmarks as well to be able to demonstrate that you've had some success in the past, and those are laying the groundwork for future successes. But the investor wants to know how are they going to make money? How are they going to get a return on their investment? And they know you're solving a problem, or at least hopefully you are. So it comes back to that business model and sustainability. Cost management, I think it's fairly intuitive that if we have to forward invest in things and something's not working, we're failing fast and making decisions, hard decisions quickly, so that we're not overspending for too long on things that are not productive for us. When we talk about burn, break even, and cash flow, so cash flow is about timing. The P&L is about a revenue picture, so they're not the same thing. I could show in my P&L, I could show an EBITDA loss or an EBITDA gain. But I might run out of cash, even though it says I'm EBITDA positive on my P&L, because the cash flow has to do with when I'm getting paid and when the money's going out, et cetera. So being able to speak to how many months of runway I have of cash on hand, my break even is about when I'm turning positive cumulatively over time, what month and what year that's happening. And how much money I'm burning right now, what was it before, what do I expect it to be in the coming months, and why is that? Are there opportunities for improvement? Are there opportunities or possibilities that it might increase, and why? An investor wants to hear me speak intelligently about these numbers in particular, because they all directly relate back to not only profitability, but sustainability, because it's also about cash in the bank. And that, I think, talks about path to profitability. So the last two, history of capital efficiency. I want to be able to tell an investor that I made an investment in X, we spent money on Y, and these were the outcomes, these were the results, whether it was an ad campaign, whether it was investment that I took in, whether it was a loan that I took, these were my use of funds, and this was the outcome from that use. In an ideal world, at a bare minimum, if I spent $100, I would make at minimum $100 in revenue. But ideally, I'm going to be able to tell the investor that I made $400. Now, in the beginning, when we're forward investing, we can't always get to that 1-to-1 ratio, but certainly over time or in small instances where there's been some testing, hopefully we can show that there has been a multiple of a return based on what was spent or invested. And to the extent that we can track and find those instances, it's really important to be able to highlight those. It's also important to understand when it's not happening and how frequently, so we don't spend money unproductively, inefficiently, and run out of cash. And I think that's probably also related to the key operating expenses. When we talk about G&A, these are things that are just day-to-day businesses. If we have a lot of fixed costs, there, that's if we own our manufacturing equipment, or if we have, we're very personnel heavy. These are the kinds of things that can be a drain on cash if we're not getting a return for those investments. And so we need to be able to understand how the day-to-day business operations are actually producing revenue. Tom?
Yeah, I'd like to add a little bit on capital efficiency, only because again, it's sort of things I see and hear currently that are happening. Seen a lot of brands lately, not brands that are bootstrapping. When a brand is bootstrapping, yeah, you know, getting to one in terms of I spent this, I got this can be very, very tough. But I've talked to many brands lately who have raised a good bit of money, but their capital efficiency isn't working, and it's lower than 1, and they're out of money again. And I think there's some reasons for this. Yeah, certainly brands see money as a chance for growth. If I have money, I can grow. So they go out and they try to grow as quickly as possible. And it's to Michael's point, it's not money well tracked. It's not money well spent where they are growing. So again, that idea of, can I do it successfully regionally? Can I do it successfully with a core set of consumers who I know where they are, how to reach them, I think becomes very important at driving your capital efficiency, especially after you start to gain some money. I also hear from a lot of investors who are worried about brands going to crowdfunding so often, only because crowdfunding seems like a source where you don't have to report back to people how you're doing. You know, you don't have, there's nobody looking for those key metrics. So it's a tendency perhaps to not think as clearly about where and how you're going to get the return. So just things that I'm hearing when I talk to investors, and as Michael said, we talk to a lot of brands, we talk to dozens of investors a month, new ones, ones we haven't talked to before, and we see some of these things come out.
Actually, Tom, if I could add one other thing, since you hit on something important there, as it relates to that raising capital and showing capital efficiency. You know, with the environment that it is today, trying to raise $1 million, $2 million, you know, is becoming a lot harder than it is to try to raise a smaller amount, 250, 500, 750. It's not going to last as long, but the idea is you want to take that investment and hit some milestones and prove to the investors that you can be successful and a good steward of their capital. Do what you said you were going to do, and then get the next tranche of investments, so that because it's going to be hard to, as I said, to raise a large sum of money, but it'd be easier and quicker to raise a smaller sum of money, and you could use those smaller sums to hit those milestones on the short term that get you to that bigger picture. All right, number 3.
And that's a great lead in, Michael, for the next one. You know, compatibility between you, your team, and the investor is really important. I think it was Andrew Carnegie said, teamwork is the fuel that lets common people achieve uncommon results. And that's what an investor is really looking for. You know, there's always got to be this opportunity to do more, you know, when they get involved, because of their money, because of their expertise, because of the contacts they'll bring to you, because of the relationship that you'll have with them. And now a selfless brand, a self-serving Brandjectory plug. Relationships is what it's all about. We had a meetup last month with a number of folks in the alcohol industry, and one of them was Taylor Foxman, and she talked about never call anybody for the first time with a request. Have the relationship already there. It's the same with investors. You want to have a relationship so there's a compatibility between you and the investor. So when that investor starts looking at you, starts asking you about your business, the things that we've talked about, you have that relationship where you can take, you know, their critical analysis, work with it, understand it, move forward. Likewise, you want to know that investor is going to give you good information. You want to know that's the right investor for you. You want to know they're going to bring the right things to you that make your business grow, that together the sum is more than the parts. Old, but very true here. So with that, I'm going to turn it over to Michael to talk a little bit about those things that really involve you, your team, and the investor in terms of working together ongoing, whether it be a small investment or a large investment.
Thanks, Tom. I think about the fact that when we take money from somebody, whether it's an investor or an institution, we now have accountability to them. And so that is something to think about from, a mental state. They've given us money. They want us to do something with it. We need to provide an outcome. And some people are fine with that and other people are not. And so I think that that's an important thing to think about. The other thing to think about when we take investments is that we are offering something of value. The investor is interested and wants to be part of that business. And so we are not, as a founder, I'm not just going to accept everything that the investor says that they want, because I want to come at this from a position of strength. I have a business, there is value to it. Now, I might have different ideas about what that value is versus what the investor thinks the value is, and that's fine. That's what a negotiation is for. But the idea is that I'm not in a weak position that I just have to take whatever the investor is offering, unless, of course, I'm almost out of cash. Then that's a different story, and I hope you never have that situation. So think about this as a partnership and as a marriage, and you're going to work together because you both want to achieve a positive outcome. And by the way, what is that outcome? So I'll just jump right to strategic alignment. Let's make sure up front when you're talking with that investor that their idea of the outcome is the same as your idea. Do they want you to achieve X amount of dollars in sales in 3 years or 10 years or 20 years? Do they want you to sell to a strategic? Do they want to have other investors come in and take over the company? Do they want to have their own people, their friends come in and manage the business? These are all things that you want to make sure that you're strategically aligned with that investor on, so that there's no surprises when you start getting into the day-to-day management after you have already signed that contract and term sheet. So from an investor type standpoint, let's talk about compatibility there. Of course, we all know there's high net worth individuals that will write, we'll call them small checks, $25,000, $50,000, $10,000. Angel investors, friends and family. There's traditional private equity and venture capital funds and strategics and family offices, crowdfunding, which is, as Tom said, is maybe an accredited investor, may not be, depending on the type of campaign you're running and what platform you're running through. So all of these investor types have different expectations. They have different philosophies. They have different agendas, and they have a different way of approaching how to grow the business and what kind of things they want to achieve from the investment. So without getting into a lot of the specifics, I'll just make a very broad stroke that an angel investor is betting on you because they're at this early stage. A venture capital might have that same approach, but their idea of growth is far accelerated compared to the typical angel investor. The venture capitalist wants to have 10x growth in 3 years, whereas the angel investor might be okay with doubling every year for the next 5 years type of a thing. So think about the investor type and what their expectations are. Compatibilities, well, I think that's redundant with what I was just describing, but again, so let's talk about chemistry. Chemistry, this is a relationship, and anytime you're dealing with in a relationship, you have to feel good about the person that you're working with. Just because they have money doesn't mean that you have to take their money or that you have to work with them. It might be a personality conflict. It might be, something doesn't feel right, but the way that you can help to become a bit more comfortable with who you are potentially going to be working with is find out who else that investor has invested in, and then go talk to those founders. Find out what it's like to work with those investors. Find out what it's like to work with the investor in good times, and find out what it's like to work with them when there's big challenges. How that investor responds in different scenarios could be very telling in terms of how, of course, they might be working with you as well. And then, of course, when we talk about compatibility, there's all sorts of things as it relates to the term sheets about valuation, the instrument that's being used, what kind of dilution expectations there are, board of directors seats, controlling rights, et cetera, et cetera. And so these are all things that come into the negotiation, perhaps on a term sheet. But upfront, of course, before you get to that point, hopefully you've got some sense of things. But it's critically important, of course, that this is a two-way street. This is not a, well, I need your money and I'm just going to take whatever you're offering. Tom, anything else you want to add?
Yeah, I'll just add one thing here. From an investor perspective, we talked about this, your team, they want to know that that team can move forward to success. That gets more important as you get into larger raises and larger revenue. So the angel investor, the private investor, maybe a small angel group, may be less concerned about that. They like you, they like what you're doing, they like your product, they see the market. That may be good enough. But when you start getting into growth rounds and approaching Series A rounds, those investors really want to see you transform from founder to CEO. That means making tough decisions. That means working with your team wholly. They may want to talk to your whole team at some point in time. You may want your team to talk to them. And, when you get into a Series A world, you're going to have that relationship with an investor because they're going to want to talk about who your CMO is, who your CFO is, what the strategy is over the next few years, all these things. So making sure you concentrate on this is an investor that's not only going to work with me, but is going to help me get there becomes very, very important.
And I think with that, we'll move to Q&A. I'll stop sharing my screen. Alexandra, did you want to jump in here, or do you want me to just read from the chat?
Yeah, I can read that. I see Chris has a question. And first of all, thank you so much for the presentation. So much valuable information that you covered. So for the first question on doing everything investors want, what are some tips to avoid working for the investors and still being able to pursue the vision established?
You want to start, Tom?
I think, again, this goes back to, if you and the investor agree on the plan, if you and the investor have a real clear idea of where you're going from a strategy perspective, who's going to do what, I think that helps. It always makes sense that if you have an investor or a board of advisors who are also investors, you do the regular reviews with them. You make sure you plan out goals, what the objectives are for the next 3 months, 6 months, who's responsible for it, who on your team, you, someone else, and you track that, and you make sure you give them that communication. Remember, usually that question is going to come from they don't know, they haven't heard. It was supposed to be done. This hasn't taken place. So the better you're communicating, the better relationship you have. I think that's going to keep you from actually working for the investor. And I'll tell you, the investor really doesn't want to be in that place. They really want to see you grow on your own as both a business and a person. If they're really an investor who's in sync with you and looking for your success. Michael, anything else to add?
Only one thing, and I guess I should have mentioned it on the last slide. When you think about the type of investor that you want to work with, each investor is going to bring something different to the party. And so if you, smart money, as they say, is going to be an investor who has connections, who has experience in the category or in the industry, who has, it's not just about money, but it's about who else can they bring to the table, whether it's on an agency basis, consulting basis, resource basis. It's how else can the investor help aside just from money. And I think that being able to evaluate an investor's value is an important part of that process as well. And I think when the investor can bring a certain element of expertise or support to the relationship, then I think, more often than not, you're going to have more of a partnership, and it's going to be a give and take.
Chris, did it answer your question? Do you have any follow-up? Okay, perfect. Thank you. Another question we had from Nick. Do you recommend a safe or more formal documents for 50 to 100K checks?
Michael, you want me to start?
Sure.
it depends more upon the size of the raise and where you are than the check actually being written. I think if you're raising, 500,000 or so, 500,000, maybe up to 1 million. I always prefer to see a convertible note there. I think it's more understandable by everyone involved. There's a lot of safe notes out there. They don't, they're not as well accepted or as well used by angel investors in the CPG space. Yes, in tech, they're very common, but the parameters in tech of where people think the brand is going to be, the business is going to be, are very different than a CPG. So I think the clarity of a C note early stage, when you're only raising 500,000 or 750,000, really becomes much clearer for both the possible investors you're attracting and for the down the road investors who are going to look and say, what does this mean to the cap table? When when they go to invest, what does that look like? Who am I dealing with? What am I dealing with when I get there? Those kinds of things I think are very important. And to mention also, never, in my opinion, always be very, very careful about mixing valuations, mixing, instruments. The more consistent you are on the cap table, the more you're going to be able to deal with serious investors down the line. I don't know if I've ever seen a brand that doesn't have a messed up cap table. I mean, I hate to be like that, but it's the honest truth. And I think if you, talk to Steve Plattman at Atcham or a few other folks that we've had on calls with us, they'd tell you the same thing. It just can get very, very crazy with your cap tables, because people are anxious to take in money and they're anxious to have that next investor. And if that next investor says, I'd rather have a C note, I'd rather have equity, here's why, they're willing to do that. But it makes a lot of things very, very confusing down the line. And it could result in costly legal work. So consistency is as important as the type of vehicle. And I think consistency comes down to not changing vehicles just because of the size of the investment. Michael?
I'll add one point and then actually I have a question back for you, Tom. If we're talking about friends and family, that's probably going to be a safe or a convertible note. Maybe it's even a loan. Once you get into more of a formal raise, then you've got filings that you need to account for, and there's more legal fees and so forth. So, think about that, and consistency is the key piece of it. But Tom, a question that I often come across, a scenario I often come across, I wanted to pose, and maybe it's helpful to the group. I've come across a number of founders who are raising some amount of money on a convertible note at with a valuation cap, and another investor will come in 6 months later, and things have changed in the business, and they're willing to offer either a higher valuation cap or they'll take a smaller discount or things like that. If it's the same note in the same round, how should a founder approach that situation where they're getting a different or better offer from a subsequent investor?
Again, I think what you said is there's significant changes in the business, and I think that warrants a founder taking a look and saying, okay, we're going to close that note, we're going to open another note. Okay, you always want to be moving forward. You never want to be moving backwards. Okay, so when you have that opportunity of sustainable, ongoing results that have significantly changed the business, then I think it's fine to think about, okay, maybe I do have to do some different filings. Maybe I have to do this, I have to do that. But I think that's when you decide to do it, especially if it's a significant dollar amount coming in.
Thank you.
Thank you. Next question we get from Mary. What are your thoughts on providing equity for service when you have consultants you've been working with during your launch phase and you want to continue working with them?
Want me to start with this?
Sure.
I can at least talk to this from the consultant perspective because I have been doing consulting work and I have these arrangements. It's important to, first of all, as a founder, protect your equity. You want to maintain control of your business. You don't want to have a very complicated cap table if you can help it. But in the beginning, when cash is tight, it makes sense to try to offer others who are dedicated to the business some piece of the action so that they are incentivized to work on your behalf. There are some, it ranges all over the board in terms of how much equity you might offer. I've seen it as low as 0.25, a quarter of a percent, which quite honestly, from a consultant standpoint, is almost not worth the effort. So, more common is somewhere between half of a point, 3/4 of a point, maybe a point of equity, but it vests over time, and hopefully there's milestones also associated with that with achieving that full amount. It is a way for founders to bridge the gap between trying to cover their cash flow, and it is something that I know a lot of my colleagues in the industry will do, but it's also something that you want to make sure that you're using that person for to the full extent that you can for their expertise and that you've also set some boundaries on their availability. I can't imagine that a consultant would accept an open-ended, I'll answer a call as much time as it takes and do as much work. Typically there's going to be a fixed number of hours, a handful of hours on any given week or month, and depending on how much equity is being offered. But hopefully that gives you some guidance. But it is a common thing to do. And I don't know, Tom, if you want to add anything.
The only thing I'd add is if you're going to use equity to compensate employees or consultants or board of advisors, you may want to make sure that you talk to your attorney, your accountant, set up a certain amount of shares. Okay, so if your company's 1,000 shares and your pre-rounds here, some number, set aside 100, 200, so that you use them wisely, so that you know where you're giving them out. And that you don't impact everything else you're doing. So that's something I think is important if you're going to start to go down that road.
Good point.
Thank you. We have 4 minutes, so just want to make sure if you guys have any more questions, add them to chat box. I have 2 questions. First, I've seen on LinkedIn brands are posting about being on Shark Tank recently, and I'm just curious, what are your thoughts on that type of going after funding on Shark Tank?
Go ahead.
Okay. Having been the hang on the phone for a brand person, Susan and I did that before. Shark Tank is great exposure. Okay, it absolutely is. But remember, it's not a necessarily friendly environment, right? I mean, people will hear bad things about your product, okay? As well as good things, okay? But it's great publicity. It puts you out there. I will tell you this: if you are going to go on Shark Tank, make sure your e-commerce site is as solid as possible, okay? I've talked to a lot of brands, and that within the hours of the first showing, their websites have crashed, okay? So please make sure that you really make sure your website can handle traffic. It doesn't matter, if it's a slow night or a busy night, you're going to get more traffic than you ever experienced. Same if you're on QVC. I've seen brands, they've shown pictures of themselves on one we know pretty well. They were on QVC and they had boxes lined up out the door at the production company, for 8 minutes on QVC. So think ahead when you do these things. And remember, not all the deals at Shark Tank go through. These folks are sophisticated investors, and they have rules. They want to make a return. They have rules, and they probably, in my opinion, they probably make more money off the TV show, doing the TV show, than they do off some of their investments. So you have to think where their heads are as they're trying to make a deal with you, and what their perspectives are.
Yeah, it's definitely show. Yeah, so, and the second question, just would like to know if you can give us a little more overview of how you support brands at Brandjectory, what ways you work with them.
Go ahead, Tom.
Okay, we know and we understand that brands need 2 things to grow successfully and find investment. They need education, and they need the chance to meet people. We do that through a series of knowledge-based articles. We have over 250 that we've written. About 10% have been written by our partners. The rest have been written by us. And we give brands a profile that is investor focused, and then we consult with them to make sure that that profile is bringing out the best that they have to offer to investors. We have investors who have told us that our knowledge base and our profile are the best things that a brand can use to learn how to really talk to investors. But we also know that they need the chance to meet investors. We do that in a number of ways. We do it through virtual meetups where there are small group meetups afterwards. You get to exchange contacts with investors. We do it through mentoring and coaching. We have more than 25, 30 investors in our mentoring program, about another 30, 35 industry experts across all disciplines in CPG. We have practice pitch sessions. We're going to have mini pitches. We had a big pitch last September. We offer a classroom setting on capital planning, from a capital advisor. We offer one-on-one with a debt financing expert. All these things are just a simple part of the Brandjectory subscription, which is $69 a month. So we're really trying to give brands all these opportunities to meet, connect, work with industry investors and industry experts. And the thing about Brandjectory is we're totally CPG focused. So where you may be out on crowdfunding, or you may be in some kind of local accelerator or local community that may involve all kinds of investors and all kinds of other brands, and there's great knowledge you can acquire from all of them, we're taking the tack that we want you to meet CPG investors and CPG industry experts. Michael, did I miss anything?
Just in the interest of time, we'll leave it there.
Awesome. Well, thank you so much, Tom, Michael.
Thank you for having us.
Yeah, and thank you for all the information and attendees. So I hope you guys had a good time.
And anybody needs to talk to us, reach out. Tom at Brandjectory, Michael at Brandjectory.
Yes, and we'll see you again. We'll have another masterclass in 2 weeks, so keep an eye on your inbox. It's going to be related actually, and will be about how to have a strong financial foundation and understand financial statements as well. That will help you in investor meetings. So I'll see you again soon.
Thank you.
Thank you so much.
you.
Thanks, everybody.
Thank
Thanks
you,
for
Liz.
being
Thank
here.
you, Alexandra.
Bye-bye.
Okay.
Thanks,
Bye,
Bye,
everybody.
guys.